traders, welcome. It's good to be here. Thanks for being here on Saturday. And again, as Renee said, I'm Dean Jenkins, founder of followmetrades.com. And I'm going to talk today about options, the benefits and risks of trading with options. I just love trading with options. They are so cool. So you may already know something about options. You may be very experienced. And I'm going to talk at a very basic level. I encourage you to hang out. You may just learn something new. And maybe you'll see a different approach that I'm using. Maybe you'll disagree with it. We can have a fun conversation. But I talk to a lot of traders who are really intrigued and interested in options, but they don't understand them. They don't go, what? This sounds complicated. You know, I've heard some kind of scary stuff about options, and don't really know where to start, where to ask. And so I thought this would be a great topic, a great presentation, just to go through some of the basics and talk about the benefits and the risk of trading with options. And so please ask questions, and I'll try to answer them as we go along here. And I want to make it fun and interactive, and I'm going to move pretty fast, but stop me if you got a question or want to hear more about something, okay? So here's what I'm going to cover. I'm going to go over the basic concepts of options. I'm going to talk about just how they work, the incredible power of I'm going to talk about the incredible power of options, the benefit, the profit potential they provide, and the risks. There are risks. I mean, we got to be concerned with that. We got to understand it. We're going to talk about how to control risk when we're trading with options, and I'm going to talk about the simple strategy that I use, right? And I only buy calls, buy puts. I'm going to give the top 5 reasons, in my opinion, why that strategy makes sense, and then I'm going to talk about some next steps that you can take if you're interested in going a little farther on that. All right, we good? All right, I'm going to, before I get started on options, I'm going to tell you a short story, and I'm going to tell you the story of my worst trade ever, the worst trade I ever took. And the reason I want to tell you this story is that it got me started down the path that led me to the trading method and the risk control and using options the way I do. So I had to kind of live through this. So I'm going to tell you about my worst trade ever. I'm going to tell you about my Homer moment in trading. All right. So I'm showing a chart now. This is a chart of Intel, looking back in time, quite some time ago. This is a weekly chart of Intel Corporation. So I was working for Intel Corporation. I started working at Intel in 1993. And that's even off the left of the chart. You can see, the split adjusted price down there is in the pennies. I started working at Intel in 1993, and as part of my compensation, we got an employee stock purchase plan and employee stock options. And for 7 years working at Intel, the stock pretty much like a clock would split and double every 2 years. And we were just printing money. It was amazing. And this was, of course, during the dot-com rise. And so because I was doing so well with Intel stock, and I was buying some other dot-com stocks, of course, they were, for a while, it did nothing but go up. I decided I'm pretty good at this. I'm a pretty good trader, right? And Intel stock only goes up. In fact, I had a spreadsheet modeling how Intel stock was going to go up for the next 5 years, and I was going to retire at 45 and call in rich, and I'd already scripted that conversation with my manager. And then, as we move out here in time, Intel inches up, boom, it took a hit. There it was late 2000, and the rest of the dot-com thing, it started coming undone. Intel kept going for a while, and boom, bad earnings report came out, and Intel took a real hit, and it dropped down to $40. And so being, at this point, the hubris, I was a great trader, did nothing but win, right? What do? I buy on the dip, man, and I bet the farm, because it was going to come back, and again, I'd modeled how this thing was going to go, right? So I bet the farm. I bought heavily at $40, fully expecting that just to be the best buying opportunity ever, right? Well, guess what? It started going down some more, and I was like, uh-oh. I intellectually knew that stocks could go down. I was aware of that fact, right? But somewhere between intellect and emotion, where decisions actually get made, I was not prepared for it to go down. I really didn't have any kind of stop loss or risk management or what would happen to my net worth and my lifestyle if I lost a ton of money. I didn't think it was going to happen, and it went down. It was like, uh-oh, that's not good. Oh, here it comes. It's going to come back. Finally, oh, no, no. Finally, here it goes. It's going to come back. It's going to come back. No. You know, you just go through this incredible stress, right? There's a ton of money on the line. And guess what? I got out of this thing at $14, right? I got out of this thing at $14. The IRS is with you all the way up there, your buddy, with their handout. All the way down, you're on your own. I still get to take write-offs to this day, 16, 17 years later, for this trade, because you only get to write off and carry forward a $3,000 per year capital loss. So it was a painful lesson. It was my Homer Simpson moment, but it taught me something valuable, right? I'm never going to let that happen again, and I haven't let that happen again. There's so many things I could have done differently, right? With technical analysis, I could have known that chart was actually heading down. Even if I didn't know that, I could have had a risk management plan in place where I would get out at a certain price and not take that big of a hit. And I could have, if I really thought it was going to go up, I had a good reason to think it was going to go up, I could have just bought some options, right? I could have just bought some options and been there if it went up and benefited from it. If it didn't, the amount I would lose would be very small, a very tolerable amount. So let's talk about options, the basic concepts of them. Okay, there's two basic types of options, calls and puts. Most people know that. So what is it? It's a contract, right? When you buy a call option contract, this is the cool part. You have the right. You're given a right, right? You've bought it, but not the obligation. You have the right, but not the obligation to purchase stock at a predetermined price anytime before the contract expires. That's pretty cool, right? We'll go through some examples of what that means and why that's cool. Okay, again, jump in if you got any questions. I love to have it interactive and make sure that you're getting what you want out of the presentation. So a put option, just the opposite. You have the right, but not the obligation to sell stock at a predetermined price before the expiration date. You don't have to do it. Okay? It's a contract between two parties. There's a writer of the contract and there's a buyer. Contract buyer is in control. Right? They have the right, but not the obligation to exercise the contract. Now they give money. The buyer gives money to the writer. Right? The writer who sold that contract, they have an obligation. They're not in control of this transaction. Once it takes place, they're not in control. They have the obligation to buy or sell shares at a predetermined price if the buyer exercises the contract, regardless of what happens to the underlying price. We'll only talk about American style options. Europeans are different. So American style, anytime during the contract life before expiration, you can exercise the contract as the buyer. So good stuff there. All right. Call option basics. So you typically would use a call option. You go buy one if you have some reason, technical analysis, fundamental analysis, you know, phase of the moon. You think that a stock is going to go up. You can just go buy shares of the stock, or you can go buy a call option contract. And why would you consider buying a call option contract? So let's go through an example here. Call option basics. Here's a Apple chart looking back at October 2014. Here it is. It's trading at $100. And you think, for some reason, some good reason, some analysis technique you use, you believe that by the end of the year, in a couple months, that Apple's going to go up 20%. It's going to go up to $120. So wouldn't it be cool, sitting here in October, if after Apple goes up to $120, that you could buy it for $100? Yeah, that'd be cool. Who could argue with that, right? Wow, you're a genius. Apple did go up to $120 by the end of the year, and because you're a savvy options trader, because you know what you're doing here, you get to buy Apple stock at $100. And why is that? You're able to do it because back in October you bought a call option contract. You bought it with a strike price. So options have their own language, and it's important to know a couple key terms. It's a strike price. Strike price is the price that you get to buy the stock at regardless of what happens. So you bought Apple call option contract with a strike price $100, that means you get to buy Apple at $100 as long as the contract hasn't expired. It's a contracted price. And the writer of that contract, they have to sell you the stock at $100 even though it's up at 120. That's a really good thing, right? Of course, it's not free. You have to pay a premium. You have to buy this contract. Right? You have to pay for that right. Cost of the contract is called a premium. Okay? And it doesn't last forever. The contract that you purchased has an expiration date. Now, if you're doing this, you want to make sure that your analysis of, gee, I think Apple's going to go up to $120 by the end of the year, you probably want to buy a contract out into February, March or something, so you have a little bit of time. You don't want the contract to expire before your thing happens. Otherwise, you got a little problem, right? You lose some money. Okay. After the date of the expiration, your rights have expired and no longer exist, right? And if the price of the stock did not go up and you didn't exercise your right, then your contract would expire worthless. You would lose 100% of your investment. Salvador says nothing's showing on the screen. I thought it was good. I think we're good here. Everybody else see it okay? Renee said on our check that it was looking good. Let me just pause there.
I can see your screen, so if anyone is having issues with that being unable to see it, you can usually try logging out and back in, and that usually will fix it.
Oh, super. Okay, so Salvador, if you can't see it, yeah, go ahead and log out, log in. Okay. Brett says his is good. Okay, good. We're just going to press on here. It's back. It was only momentary. Okay, maybe we had a little internet gremlin. Thank you, Tanya. Okay. Where was I? Okay, contracts expire, right? That's one of the basics. So you have to do your thing. You have to either exercise the contract or sell it before the expiration date. We'll talk about selling them. Okay, because this is one of the cool features. So put option, it's just the opposite. We just talked about call options, right? But it's just the opposite. If you think you have a good reason, you know, your analysis technique, you think a stock's going to go down, you can just go sell some of the shares short. And here's an important point. Assuming you are not in a IRA, you're not trading in an IRA because you can't short stock in an IRA, right? So you can go short the stock, or you can just go buy a put option contract. And you can even do that in an IRA. So this is an important point because lots of people have, you know, quite a bit of their net worth and the money they would like to be trading in the market in a deferred account in an IRA or a Roth or something. And in those accounts, you can't short the market, but we want to trade both directions of the market. You can do it with a put option contract because that's actually a long position, and you can take any kind of long position in your IRA. So that's really cool. So why would you consider buying a put option contract instead of just shorting the shares? So here we are, middle of July 2015. Apple's at $120. You think it's going down to $100 by the end of the summer. So wouldn't it be cool if you can sell Apple at $120 after it went down to 100? That would be super cool, I think. And wow, Apple did go down to 100, and because you know how to trade options, right? You get to sell it at $120. And you don't have to own the shares, right? You get to sell shares you don't own for $20 less than 20. Yeah, you get to sell them for $20 more than they're trading for. Shares you don't own. That's awesome, right? You're able to do that because back in August you bought a put option contract. You bought it with a strike price of $120. That's the contracted price that you get to sell the shares at. Sweet, right? Of course, it's not free. You got to buy this contract. You have to pay a premium, right? And it expires. There's an expiration date on this contract, just like with a call option contract. Okay, so let's talk a little bit about the incredible power of options and the profit potential that they provide. So we had just a quick glimpse into that, just the basics of how they work. Let's talk about the power and the leverage they provide, okay? And that's the key word, leverage. So in our first call, our Apple call option example, right, we bought a call option contract. So let's assume the following. These are pretty good numbers here. The strike price was $100. So that's the contracted price we can buy the stock at if we want. We have the right but not the obligation. expiration date January 2015, premium $1,000. So that's the amount you pay for the right. And for Apple at about $100, you know, a few months out in time, $1,000 is about right. That's about right for what the premium would be. So if we had just purchased the shares, right? Each contract gives you the right to buy 100 shares. So each contract equals 100 shares of stock. Okay. So if you just bought the shares, went and bought 100 shares, it's going to cost you $10,000. Right? 100 shares times $100 is $10,000. Now, if it had gone up to 120 like you thought, that's awesome, right? You make a $2,000 profit, a 20% gain. Very nice. That's all good, right? But if we had purchased the December 15 strike price 100 call option, cost us $1,000. Now we got $1,000 of capital tied up in the market and at risk, because remember that $10,000 that we bought the 100 shares with was all at risk. If there was really bad news came out and iPhone started exploding and you know who knows what, Apple could take a huge hit overnight. It's not common, but it happens enough to be worried about. Okay, so if Apple took a big hit and lost half of its value, unlikely for Apple, but it can happen to some companies, right? Some bad news comes out, and the price gaps down. All of a sudden, you would have lost $5,000, right? If Apple lost half its value overnight, you would lose $5,000. Ow, that hurt, right? With the option contract deal, you've only got $1,000 in the market and at risk, so 10% of the capital tied up and at risk, right? And what happens if that same scenario, I heard a bunch of iPhones catch on fire, blow up, and all of a sudden Apple drops to $50? You lose $1,000, right? Your option contract is going to be what's called out of the money. It's going to be way out of the money, right? The right to buy Apple at $100 when Apple's down at 50 is worthless. It's totally worthless, and it's going to expire worthless. You're going to lose your $1,000. I'd rather lose 1,000 than 5,000 for the same exact event, right? That's one of the powerful parts of options, is it can control your risk. It can absolutely control your risk. And by the way, we're going to talk about sellers of options, right? Someone who wrote those call contracts and didn't have the shares to cover them, they just got wiped out. They just got totally wiped out. That's called naked writing, and that's really, really bad. We'll talk about that in a minute. So for $1,000, right, with an option contract, you controlled or profited from the price move of $10,000 worth of shares. That's leverage. Put an option example works exactly the same way in reverse, right? You control 100 shares, $10,000 worth of shares with $1,000. Of course, you can buy more shares than just one, right? Cool stuff. And if that wasn't good enough, but wait, there's more, right? Here's something really cool about options. If you bought an option contract and the chart, right, Apple goes up to $120 just the way you thought it would, you don't actually have to buy or sell the shares at all, right? You just sell the contract, because the value of a contract, right? If you're holding a piece of paper in your hand, or virtually holding it in your brokerage account, a contract that gives you the right to buy Apple at $100 and it's up at $120, that's a valuable piece of paper or digital thing, right? That contract has real value, right? When Apple's at $100, the contract, and it's got 90 days left on it, it's got a little bit of value. When Apple's up at $120 and you are holding a contract that lets you buy it at 100, that has real value, right? And you can just sell it. And there's a good market for option contracts. I hardly ever, right, in the last 5 years, I've exercised 1 or 2 option contracts, but I've traded hundreds, right? I just sell them. I do my analysis on the chart. Oh, look, this is going up, right? Go buy a call contract using my method, my exact criteria. It goes up. Price gets up into my target zone. It's time to get out. I go sell the contract, take a profit, right? So selling contracts that you own, this is the bottom line on the slide here. Hey, Anthony, I'm glad you made it, man. Selling contracts that you own is different than writing contracts. So that terminology is important, right? Because both transactions are selling. Okay, understand it. It's important. When you buy a contract, you are buying to open, and when you buy one that you own, it's called sell to close, right? Someone who's writing contracts, when they open a contract, it's called sell to open, buy to close. Okay, those terms are important. You don't want to mess it up and end up writing a contract when you thought you were going long. Okay, what about the risk? Yeah, there's no free lunch on Wall Street. As powerful as options are, there are definitely some risks that you got to be aware of. They can be very well controlled, right? There's nothing to be afraid of if you understand, but there are risks. Unless you're writing contracts, and you may get, if you're a more experienced option trader and you're just listening in here, and even if you don't know much about them, you may be getting the impression that I'm not a fan of writing options. I'm not, right? And then we'll talk about my top 5 reasons for that, okay? But for writers of options, those who are obligated, right, under the contract, they received money, they sold the contract, so they got their benefit was the money, and by the way, their benefit is absolutely capped, right? If I spend $1,000 for an Apple contract, Apple call contract, right, I give the writer of that $1,000. The most they're ever going to make is $1,000, right? The most I'm ever going to make is dependent on what Apple does. If Apple goes to 150, I just made $5,000 on my $1,000 investment. So the amount that they can make is absolutely capped at the premium paid for the contract, but their risk is unlimited. As long if they're writing naked contracts, if they own the shares, different story. But if they're writing naked contracts, writing contracts against shares they don't have, right? Their risk is unlimited. A term like unlimited risk makes it hard for me to sleep. That keeps me awake at night, and I'm not going to play in that sandbox personally. For buyers, those who have the right but not the obligation, the risk only extends to the premium you've paid for your contract. You go buy a contract for $1,000, what's the absolute most you can lose? $1,000. You're not on the hook for another penny. Okay, that's nice. That way you can control your risk. You can control how much money you can lose. You can lose 100% of the premium that you paid. It's rare. Like I said, I quite often sell them, even if the thing goes the wrong way. Right, and I bought it for $1,000, and the stock goes down. I go sell it for $600 or $700. I lose a couple hundred. There's no reason to sit around and let it expire and lose 100%. Okay, so I think that's a way better deal, to understand exactly how much risk you have and to have it be relatively small and have it be tolerable. Right, and I'm using the example of Apple, right? $1,000 a contract. Lower priced stocks have contracts that trade for under $100. Or some of them $100, $200. So they're not all $1,000, right? Again, you don't have to let it expire worthless. You can sell your contract, maybe for a loss, but you don't have to lose the full amount. You can have a very tolerable loss that you can take in stride and move on. So that's really important to realize. Okay, there are 2 options for writers: those who are obligated to deliver shares. They can be covered, meaning they own the shares, and they can be naked. Meaning they do not have the shares, and if you exercise the option contract, they have to go buy them, right? So just imagine, right? Somebody wrote an Apple call option contract, right? $100 strike price, goes up to $120. I go, yes, I'd like to exercise that contract, please. I'd like those shares of Apple at $100, and it's trading at $120. This naked contract writer, hey, they have to go buy the shares at $120 and sell them to you at $100. Their broker does it for them. In fact, yeah, their broker does it for them whether they like it or not. That's part of the option contract deal, right? The broker just takes care of all that when you exercise it. So for buyers of options, one of the big risks you have is that it has a deadline, an expiration date. And if the price doesn't go the direction you thought it would, up for a call, down for a put, by the expiration date, your contract will expire worthless. It will be worth $0. So, but again, the risk only extends to the premium you paid. You can lose 100% of the premium, but no more, right? The writers of the contracts, their risk extends well beyond the amount of premium they received for the contract. Okay, I don't really like that. I like knowing what my risk is. Okay, so clearly we do not let contracts expire. We get rid of them before they expire. And if it's not going our way, we take a small loss. And if it's going our way, we take a nice big return on it. Okay. how to control risk. One obvious reason, one obvious thing you can do when you're trading options is just never write them. Never write option contracts. Now there are strategies, and people listening may go, "That's awfully simplistic, Dean." And I can control risk through bull credit spreads and debit spreads and condors and eagles and butterflies. Absolutely, true statement. True statement, right? So you can sell a contract here and you buy one here to protect it and all that kind of stuff. I like to keep things very simple. And even if you're doing multi-leg strategies and you buy this, you sell that, you can still get assigned, right? You can still get assigned, particularly if the contract you sell is in the money. As long as you are holding, as long as you have written the contract, even if it's part of a multi-legged strategy, right, you are at risk of being assigned at any time prior to expiration. Not sure everybody realizes that, and they take that into account when they start doing these strategies. You can be assigned, and if you are, right, you're going to have the cash, right, to cover that exercise. And if you don't have the shares, of course, you're going to need the cash. And if you don't have the cash, you're going to get a margin call, and margin calls get on your nerves. That's your broker saying, hey, your account needs 50 grand in it, like right now, to cover that exercise, that contract you had. When's that wire transfer coming in, pal? And that say those calls can just get on your nerves. I recommend and I follow a very simple option strategy. I just buy calls or buy puts. I generally use a 2% rule. I only spend 2% of my trading account on any one option trade. So for a $100,000 account, I would only spend two grand in premium. Contracts are 1,000 each. I'd buy 2. If the trade fails completely and utterly, I've lost 2% of my account. I don't like it. It's not what I wanted. That's not what I wanted the trade for, but that's a tolerable loss. I can recover from that pretty quickly. And in most cases, if the trade goes the wrong way, I can sell it long before it expires, and my loss is much less than the $2,000. So we can just really control our loss that way. Options are derivatives, which means they get their value from something else. Right? In this case of stock options, it's derived from the underlying asset, the stock. Right? I never go into a stock trade without having, I have a very specific method for analyzing the chart. We're going to look at charts here in just a minute, see if there's any symbols you'd like to look at, and if there's any option contracts that make sense for them. But when I look at a stock chart and I do my analysis, right, I have a entry price, a stop price, and a target price. Okay, and then after I've analyzed the chart and I figure out what direction it's going, where to get out, where to take profit at, then I go find the appropriate contract to buy. Everything is, the analysis about the time frame and the prices and all that stuff is done on the underlying stock chart. Then I go figure out what's the best contract to trade a thing with. All right, here's my top 5 reasons why I think a simple buy calls or buy put strategies make sense. And you can debate that. Happy to have a conversation. But this isn't for everybody. I know people do other more complex strategies and they do well at them. That's fine. This works great for me. I've taught it to lots of people, and we're trading it for really, really nice profit. So it's simple. My top #1 reason why just a buy call, buy put strategy, it's simple, it's easy to understand. Right? I know exactly what it costs. I know exactly what my risk is. Easy to understand. The risk is absolutely defined and contained. I can only lose what I spent in premium. If I put up $500 in premium, that's the absolute most I can lose, no more. As a buyer, I'm in control, right? I will never, ever be assigned. Nobody can force me to go buy shares, right? I have the option. I have the right, but not the obligation to act on it. I think this is the maximum profit strategy if you're correct about the trend. Other strategies, the spreads and all this kind of stuff, right? They have all these protective things built in that cost you a lot of money, and the profit's kind of capped on those, or it's minimized, offset by the offsetting position. So I think just a simple directional play of buying calls, buying puts is the maximum, provides the maximum profit if you're correct about the trend. And if you're not right about the trend, it controls the loss, right? And margin calls can really get on your nerves. If you do get exercised as a writer of contracts, you can be exercised at any time. And got Mr. T here, I pity the fool. who gets exercised and who is on margin call. All right, let's look at some charts, right? Traders, we're talking about trading. Let's get off of PowerPoint. Let's get away from Intel trade. That was no fun. Let's look at a trade, and I'll show you one that I like right now. So this is the screen that I'm showing right now is my TradeStation platform. I run a stock advisory service. So this is the 10 or 11 trades that we are in right now. And here's the position P&L column, and you can see out of 11, 9 are in profit, and there's about a $10,000 or $11,000 net profit in the positions right now on a model $100,000 account. So pretty pleased with that. We're long, we're short. We're short American, we're long AWK. Let me show you this AWK chart. So I use a combination. I call it East and West, right? So I use some. I'm standing on the shoulders of some technical analysis luminaries, Charles Dow, so he's Dow theory, Ralph Nelson Elliott, who developed Elliott theory, and Goichi Asada, who developed the Ichimoku cloud. So I use those together in an east-west kind of way. And so what I've got here on American Waterworks AWK is a really nice impulsive wave 3. I've got a really good correction, and now it looks like the next impulsive wave. We have clear proof. Green board, we got a price target up here at 92 from our entry price. We got into this at 74.66. We're already in nice profit, and I'm trading that with a contract here. I'm trading it with, here's the call contract on this. It is it's the June of 2017 call with a $70 strike price. So the June 70 call is the one I'm trading that with, and I think that's still got a good entry. So if you're looking for a trade, I think that's a good one. And what I do is, if the underlying price goes and hits my stop's sitting here at 71.69, that's when I go close the option contract. I sell it. And so in this case, I paid, for these AWKs, I paid 600, I paid, what, 609, $609 per. So, and I bought 5 of them, so that's about a $3,000 we got into that trade. And so if it goes and hits this stop, if the underlying shares hit the stop at 71.69, I'm going to go sell the contracts, and they're probably going to be selling for, $400 or something like that. So I'll take a bit of a loss, but I won't lose the entire $3,000. I'll lose $400 or $500, and I'll get out, and that'll be a tolerable loss, and I'll move on, right? But right now it's in profit. It's in really nice profit. Okay. These are trades on this this matrix here that I published to my stock pick subscribers, and one of the features in my service here is that I take these, every trade I publish to my subscribers, I'm taking them in my live TradeStation account, and you can see I've got these positions on. My money is on the line too for every trade that I publish to a subscriber. So I find the trades for me first, and then I share them with my subscribers, and I call them out ahead of time, right? But I'm not doing this as an abstract exercise. I'm doing this to make money myself as well. Okay. So anybody type in, John typed in HD. Let's take a look at Home Depot. I think I've looked at it. I don't think I like it. Well, maybe I'm wrong. Yeah, here's the reason I don't like it. You can see I had a target zone up here, and it's there already. So it's a really nice uptrend, but it's too late. We missed it. It was a good trade way back here. But it's in the target zone. It could keep going up for sure, but once it's in the target zone, I think it's kind of late for me. I don't want to do it. GS, I'm watching all the banks. Goldman Sachs, JP Morgan, Bank of America, Citibank, Wells Fargo. I'm watching them all. I mean, this has been an amazing run since the election, right? And it's going to correct at some point. Look here how GS started to correct, and so this may be good. Let's look on a 60-minute chart. There may be a shorter-term play here on GS, and there is. So this is already meeting my criteria for being ready to the correction beginning. And I think this has a target down here at about let's call it 205. That's close enough, right? So what contract would I trade this with right now? GS to go short. And this would probably be like a week or two. This is ready to go. I would, if it keeps going down Monday at the open, I would take that trade. So let's look at the option chain for GS. Okay. So I would want to be, so they don't have any August. It's going to go, well, we're on a 60-minute chart. So the July, let's go look at the July puts. Puts are on the right here. And using my criteria, I've got very specific criteria. I want to be deep in the money, high delta. I want it, plenty of liquidity. So yeah, I like the 260, the 260 put. Not cheap, man. 2,220 bucks per. Not cheap. But that's the one I like if I was going to do GS. So let's look at, there's some cheaper banks out there that are probably doing the same thing. Let's look at JP Morgan. Yeah, JP Morgan's trading here at 90 bucks, and it has tipped as well. Now it's not quite, we don't have all red or even neutral colors, but it looks like it's tipped and it's ready to start heading down. So if that goes down, you know, JP Morgan might be a way better way to trade this. It's got a target, middle of the target zone at 80.73. Let's see what their puts are going for. Okay. It's loading the data. Oh, wow, look. TradeStation just totally locked up. Nice. Beautiful. It's going to shut down on me. Well, oh no, just Option Station Pro. Anyway, hey, I'm getting close on time. So what do I think of a butterfly strategy? I don't care for a butterfly strategy, Les. I look for a directional trade, and then if I think it's going up, I got good reason to believe it's going up, I'm going to go long the calls. And if I think it's going down, I'm going long the puts. That's my strategy. I try and keep it super simple, and it's worked really well. You can show just a second the the profitable trades that we're in. Hey, here's some next steps if you're interested. Learn more about options and give it a try. Investopedia is a super source if you just want to learn. It's free, and they have tons of great material there and tutorials on options and basics and then advanced strategies, and just learn the terminology. If you want to continue learning more, test it in sim. Anything you're going to do, I just recommend any new trading strategy, go test it in sim. Paper trade that thing. Make sure you understand the mechanics of placing orders, the terminology of everything, and that it works. Some people sneer at sim trading. Say, well, it's not real. Oh, that's true, right? But here's two things I think are absolute maxims, absolute truths, right? That just because you're profitable in sim doesn't mean you'll be profitable with real money. That's a true statement. If you cannot be profitable in sim, there's no way you're going to make money with real money on the table. I think that's an absolute truth. So do it, prove it, and then go see if you can repeat that with real money. Hey, you can subscribe to my stock pick service. I just showed the 10 or 11 positions we're in right now. About 4 or 5 of those still have good entries right now, and I'll be providing the update tomorrow. So if you get in right now, you can be looking at those trades and getting my latest update tomorrow morning. And here's the deal. With the stock option pick service, you get 1 to 2 picks per week. These are the ones I'm buying with my own money, man. I showed that on my screen. These are the best of the best. I include option contract details on about 95% of them. I give updates every week, right? I record a video of the charts. We have a midweek live chat session you can tune into and ask questions. I have SMS text alerts when there's a change, we're moving a stop, taking profit. All that's going on. The results, my multi-year results are on followmetrades.com. We've been averaging greater than 30–40% in a model $100,000 portfolio for several years. And you can take a free trial. The marketing folks tell me free trials are terrible, don't ever do it. And I'm not a marketing guy, I'm a trader. So I'll give you a free trial. It's actually 10 days, sorry. Let me get that fixed. It's 10 days, not 30. 10 days, free trial. Yeah, you got to put a credit card in. I'm serious about providing value, and I just want folks who are serious about doing it. So 10 days for free. Then it's going to be 97 bucks a month, which is a discount. The list price is 127. That's a good deal at that. Here's the URL, a tiny URL, FMT free 10, and I will put that in the chat area right now so you can click on it. And that's only good. That free trial is only good during this webinar. When the last speaker is done and Renee says goodbye and farewell, this page is coming down. So only now. I don't do free trials very often, but you showed up for the webinar, you listened to my presentation, and I just wanted to extend that offer to you. So during this presentation, this webinar, before it ends at whatever it is, 3:30 something Eastern time today, free trial for 10 days. And if you want to cancel before that renews at 97 bucks a month, do it. You just cancel, and you won't get charged a dime, and there's no hard feelings, there's no questions asked, right? I just want to give you a chance to check it out. And during this 10 days, you're going to see some phenomenal trades that are some ready to go right now.